Welcome to RealCast. I'm joined by James Wallace, Nicol, Dynes and Judi Seebus to analyse the key themes of the week for real assets. What are the key things that you guys have seen?
Well, if I can start with the Netherlands, we're seeing the curve flattening here since the last couple of days over the Easter weekend. Fewer deaths, fewer people in intensive care. So I think what you're seeing across Europe is that different countries are at different stages. And here we're starting to see the first encouraging signs that things are starting to go back to a semblance of normality, and we saw also in the shops just before Easter that a number of stores, like the non-convenience stores, the shoe stores and a couple of clothes stores, they're opening their doors again, which is good news, I think.
Yeah, and that's interesting because we're not seeing that at all here in London at the moment. Very much in a kind of lockdown phase. It's starting to flatten a little bit. But the expectation here is that we're still waiting for the peak, really. Nicol, what's the view from Italy at the moment?
Well, Italy, much like Spain, is in the second phase, hoping to be in the recovery phase. So it is also looking at opening up very, very gradually. And some companies are being allowed to open, and some shops, in non-convenience stores as well. But it's being done very gradually and very cautiously. And obviously in the UK, there's a lot of interest in what Spain and Italy are doing, because the UK is a couple of weeks behind.
And in terms of big themes on the industry front, I suppose what are the particular things that anybody wants to pick out?
I think Blackstone raising almost 10 billion for its opportunistic fund. I think that's one of the biggest news stories of the week. They raised, I think, more than 2 billion more than they had anticipated. So I think that's a sign that we're going to see some activity in the coming weeks and months.
Yeah, I would say to add to that it's a sign of the cycle. I mean, one thing about private equity capital raisings is they always state a number and then they think that they can beat. And so whatever number is made public prior to the final closure, you always expect it to increase. Now, they obviously have been raising for several months, and Blackstone's long record is sufficient for their LPs to have confidence in them that they can adapt quickly to whatever business strategy for this capital that they had back in September. And they're very well placed to kind of take opportunities as they arise.
And does that mean, do we think that we're going to see a lot more capital heading towards real estate? Because there seem to be differing views on that.
Yeah, I mean, the relative value of real estate, I think, will hold up as we have this flood of new quantitative easing because of the volatility in equity markets and the low yields in fixed income. But the relative value of real estate will be segmented further, and so there'll be parts of the real estate universe which will be less attractive, obviously, which we've discussed in the past. But areas, assets with, if you like, government covenants will probably receive a greater premium in the future. So there'll be some flight to quality, and we might even see a further segmentation of existing prime assets.
People will be looking very carefully at which sector they choose, and depending on whether they're an opportunistic buyer like Blackstone or a core institutional investor, they may or may not wish to invest in retail, which I think is retail real estate will be one of the most distressed sectors in the coming period.
The thing about the retail space is, I think prior to the outbreak of COVID, certainly the back end of last year and the very beginning of this year, before any of us really realised quite the significance of what was to come, there were some sort of contrarian calls that maybe some of the big investors might take a punt on retail this year. And I just think that those contrarian business plans will probably be shelved now.
I think we're going to see a battle of survival, and it's already started. I mean, we've seen in Germany that Kaufhof has collapsed, the big German department store chain. And I think we're going to see more chains and smaller stores having a very, very difficult time and potentially collapsing.
Absolutely. I mean, Debenhams, 240 odd years old, has announced intention to appoint an administrator. The acute problem is that they have an immediate cash flow requirement, which is sooner than they have time to gain access to some of these government schemes. In the UK, for the medium-sized schemes and slightly smaller, large schemes, that government scheme isn't even available yet. It doesn't become available until the end of April. And the process of getting the funding via the accredited lenders was probably going to take around a month. So you're talking about at least 6 weeks from now till then before commercially and financially viable companies have a chance to get access to this cash. So this is exactly a race for survival, because a lot of people won't make that 6 weeks.
I think there was an interesting report that Collier's brought out about ranking government responses to the crisis in Europe, and it came out that Denmark, Germany, the Netherlands, Sweden and the UK were the top, that performed the best, precisely in what you were saying, James, in the speed of delivery to sectors of the economy that need cash, need liquidity soon. So other countries have announced plans, but they're very slow to implement them. And obviously time is of the essence at the moment for companies to survive.
Yeah, one of the points of that study was that these countries that you just mentioned, the UK, Sweden, the Netherlands, Germany, they've got an existing infrastructure. They're already, they had things in place that they could, which made it easier for them to move swiftly.
There's one final point I was going to make on that, Richard, actually, is I think the government in the UK, I'm talking, they came out really quickly with what they thought was reasonably comprehensive schemes of support. And to one extent, they should be praised for acting quickly, but their speed of communication of support to the market was not matched by the smooth execution and thought through plans. What they actually did, these schemes, are actually from existing frameworks that goes back to the global financial crisis era of emergency schemes there. And so they ported those rules and those requirements over, which in part don't really apply to the here and now. And so there has been confusion both among the accredited lenders in terms of what the requirements are for government security for these loans. And of course, the customers don't know quite what they need to do to prove viability. So there's this slow moving response. And just to put one stat on that came out last week, which I thought was noteworthy, the Seebus scheme, which is the small scheme for up to 5 million loans, the 40 plus accredited lenders in the UK have received in aggregate more than 300,000 requests for these loans, and the banks collectively have only approved about 5,000. So they're swamped in demand, and they don't really have the fluency to process. And you add to the fact that banks are kind of slow-moving beasts anyway. It's no surprise that we're seeing these kind of collapses, and it's going to hit the most vulnerable first, and that's retail.
And it will also hit the most vulnerable landlords. If you look at Unibail Rodamco Westfield, I mean, they're the biggest in the world. Last week they announced that they'd raised 1.4 billion in debt, and that debt issue was that bond issue was oversubscribed. There was more than 3.3 billion of capital willing to invest in this company. Now the rates or the spreads have gone up by part of the loan was 150 basis points, but this shows that there's already a lineup between the ones that are definitely going to survive and others who will fall by the wayside.
Lots of discussions around whether or not this is now a solvency crisis in a way rather than a financial crisis. But is there a sense that may also lead in some ways to more pressure on the banks, or do we think that there's a feeling that the banks are this time in such better shape that's unlikely to be an issue?
Most commercially, financially viable companies should you'd like to think, if they're well run, would have like this. What insolvency practitioners see is kind of that 13-week cash flow horizon, and so. If they do, that should be sufficient for them to gain access to these schemes, even though there's been some delays at the outset. So we're only sort of less than a month into this, and So over the course of the next, say, 6 to 8 weeks, hopefully a lot of needed companies that are deserving of this funding should get it. For those that don't, then they probably weren't strong enough coming into this. But I don't think it's necessarily an issue within the lenders. And I think the lenders have been actually given more flexibility from regulators to actually, they've had their kind of capital buffer requirements kind of loosened so that they can actually lend more and hold less in reserves. So there should be plenty of liquidity. Why the banks are being slow is they want to make absolutely sure that the loans that they're extending comply with the requirements for these government-backed schemes across these nations, and so that they don't extend loans without that government security, and that they're solely standing behind themselves. So that they're being deliberately slow and cautious until they get that right. And hopefully over time that will speed up.
I think you're also seeing a difference here between the countries that were mentioned previously, the Nordics and Germany, the Netherlands. In the Netherlands, for example, some of the banks are offering landlords mortgage holidays of up to 6 months. So there's a division, or there's a split between the wealthier north and the south, which I think that will become more pronounced during this crisis.
I spoke to Maurizio Grilli of BNP Paribas, head of investment management analysis. And again, it's sort of this looking beyond the immediate next few weeks, and underlining the fact that obviously Q2 is going to be pretty much a write-off. No one knows how long this crisis will last, but they're looking beyond that, that investors are very quick to sort of capture sentiment changes in the market, and as soon as there's some positive news, investors will come back in, and the demand for space will continue. In fact, will come back with a vengeance, as it were. So that obviously, particularly in some sectors like logistics, but in general, that the prospects for real estate are bright. And the other theme that is interesting is the change in capital flows in the short to medium term. And obviously in Europe, it's mainly cross-border capital that plays a huge role. And that's going to go quiet inevitably because people are in sort of wait and see mode. But so there will be domestic players who know the market very well, who are going to spot opportunities. And as we were saying earlier, the opportunistic players, sort of the Blackstones of this world, who will obviously that's their role, to spot opportunities in distressed times. So that's what will happen in the next few weeks. And then eventually the market will return to normal with the sort of institutions doing cross-border deals as they have done in the last few years in Europe.
Investors are going to be cautious about some sectors, because I'm hearing noises from players like Deloitte that they're talking about freezing business travel after Corona, and there will be new ways of working. We're already seeing that. There was a research report this week that shows that a very high percentage of people, 80%, likes working at home, wants to work at home more often once the crisis is over. The way we work is really going to change.
There are lots of different opinions. And for example, yes, as you were saying, definitely everyone has found out that it is possible to work from home. But at the same time, the sort of weeks of isolation have also shown how important human contact is. So someone was saying that, for example, we'll have fewer offices, but more meeting rooms, that people will maybe work from home a lot more, but then they will want to meet once a week face to face in a meeting room, maybe a big meeting room, so they can keep their social distancing, which maybe will carry on for longer than it's mandated. And another thing that I heard was that there will be offices still, but there'll be smaller offices. There will be the end of the big open plan offices that we've seen. There will be more individual cubicles again, because they'll be seen as safer. So there are lots of different ideas about what the future offices will look like, but I think that's a really interesting sector to keep an eye on.
Great. Thanks very much, everybody, for your time again this week. Next week, we'll be back again as regular on Monday, looking at some of the key themes for the week. Thanks very much.